Well, last year, if you were here, you remember that the theme of our presentation was sixth inning strategies, because we felt that there was a consensus that we were in about the sixth inning. I'm curious to start off with an extension of that theme and to ask the panelists if you had to continue with that baseball metaphor that's easy for all of us to get a hold of, what inning would you say we are in now? And do you feel this is a good time to be a buyer in this market?
I'll start. I still think we're in the sixth or seventh inning. I think there's a high probability it's going to go extra innings. Things still feel really good from our end. Do I think it's a good time to buy? Absolutely. We're on the sideline still right now. Our plan after we bought ProBuild was to continue to delever for a few years, and we're getting to the tail end of that plan, but we're still on the sideline from an M&A standpoint right now. But I do feel like it's still a good time to buy.
Great, thank you.
I would say we're in the middle of the seventh inning stretch, actually. So I'm waiting for somebody to sing the song. But from my standpoint, I think there's a lot of, not necessarily hesitancy, but they're looking at what's going to happen. What are the tax law changes going to do? How long will this good market stretch continue? There's a lot of evaluation and analysis of that. So, but I agree with Chad. I think it's a good time.
Yeah, I'm just going to echo what they said in terms of timing, and I agree. I think we've got a long way to go in terms of a solid, stable economy and market for what we do. We've had now probably 10 years going of underbuilding of homes, and so I think there's just there's a lot of positive things to look at out there, and as we all look at our businesses, and certainly. On the question about acquisitions, I hope it's still a good time. We did 3 acquisitions in the fourth quarter, so if it's not, we just made a lot of mistakes, and I don't think that's the case. And we've got a lot that we're looking at right now. I think this will be an active year for Kodiak from an acquisition standpoint.
I would echo the same sentiments in our industry. We did 10 acquisitions in 17. We've done 2 in the first quarter. Got probably 3 signed up now. And so we are an acquisitive company, and we plan to do about the same in 18 as we did in 17. But I do believe, like Dave said, we're probably in the middle of the 7th. I think Michael said, I want to wait another year, I want to wait another 2 years. When somebody says that to me, I say, I might not be a buyer next year or the following year. And I'm not just saying that. We might not be.
If I am going to sell, I want the most value for my business. You, as a buyer, what is your ideal acquisition? What is the acquisition that you're willing and comfortable to pay the most for because of the characteristics that it has? What are those characteristics for you that, from a value building standpoint, our industry members can emulate and put into place in their business? We'll start with you.
Let's start with Ruben. I know he hates being last every time.
There you go. Well, we're kind of going back and forth. Yeah, go ahead.
I'll go first. I don't think that's a black and white question. I think sometimes you're trying to consolidate a market to get the number 1 position. So you buy somebody an in-market deal, and you pay more because the synergies are better. There may be some consolidation in there, which is not great for some people, but it may play out good for the buyer. And other times you're trying to fill up some white spaces in the map for us, in which case you might pay a little bit more. But what we like to see, a lot of times their vehicles are older, so we have to discount for that because CapEx is going to be higher in the coming years. A lot of times their days outstanding are a little higher, and so we buy usually an asset deal with a cash and debt-free, cash-free business. So you take the debt, you take the cash, and so all the cash conversion stuff is that becomes, we have a net working capital adjustment after about 90 days, and we set a target based on an annual net working capital of your company. So if it's over that, that's yours. So dead stock, slow moving inventory, over 120 days, it becomes yours after the deal's done. So that if it's cleaner, it's better for the seller. I could go on for a long time.
Go ahead.
No, go ahead.
For us, I think I'd answer the question a little bit differently. Our strategy and vision for Kodiak was really a lot about embracing kind of the independence and the local nature of our industry. So, you know, in our acquisitions, companies keep their brand names. We continue to operate in that local market, really as that company always has. And so for us, you know, it's about culture, leadership, and being in a market that's got good long-term demographics in it. So those are the things, certainly the numbers, all the things Ruben talked about are critical and baseline kind of things that we've got to have in an ideal acquisition. But you know, what really makes an opportunity sing for us is a culture that mirrors ours, a leadership team that we can really partner with and grow that business together, and then a market that we think we've got a lot of opportunity in.
Steve just read my notes, so. No, actually, culture is very important to us for a couple of reasons. One, most of our targets are going to be single entrepreneurial operations. But secondly, because we're a small company, we can't afford to make an acquisition mistake. So if that culture's not right, now then we're pushing that rock uphill, trying to convert it into our culture, if you will. Asset management is important to us. People are important to us from a leadership point of view as well, because we just don't have bench strength that we can go in and replace key people. So we need that bench strength that the acquired company has.
Yeah, I'll echo what these guys have said. I'll add product mix is very important. Value add content. Are you pre-hanging doors? Are you providing millwork or building components? We always like to see that. Market share in a particular market is important to us. And then from a people standpoint, I agree with everything these guys have said, but I'll just add that some sort of succession planning is important. If you've got an operation where the owner is basically the only one that has all the relationships with the customers, that can be concerning. And then if you have a high concentration of customer mix, especially in the scenario I just described, it's concerning as well. So having a good succession plan and making sure others within the organization have good customer relationships as well is important.
Working with companies that I have made the decision to approach the market and sell their business, we have learned that outside of their family, their business is the single most important thing in their life typically. Maybe their family and their faith. Next would be their business. How do you get a selling owner comfortable with the fact that they're handing the baton to you? There's no line in a purchase agreement I've ever seen that says, we promise we won't change anything. We promise we'll keep everybody that you've got here. We'll get, you know, everything will be the same. You don't even have to worry about it in your retirement. How do you give a business owner comfort on that point of the legacy? Your legacy is a little different than theirs. Your culture might fit but be different. How do you get a selling owner comfortable with passing that baton?
Yeah, again, I think it's transparency. And gosh, we've seen, you're right, most owners are passionate about their business and they want to make sure their people are cared for. So especially in some of the smaller deals, if we need to go person by person with the owner and say, here's the role we see each of these people playing post-close, here's what's going to happen the first 30 days, here's what's going to happen the first 90 days. I think as long as you can just be clear and concise and transparent, that's, in my opinion, that's all you can do. And in some cases, they don't like what they hear. In many cases, they do. But what you don't want to happen is there be some miscommunication. And right out of the gates, day one, there's friction, because that's not good for either party.
I think it's also important that they're talking to somebody in the business. It's not like we're McDonald's or
Sure.
The legacy is somewhat intact, especially if we keep the name on the door. And from an employee standpoint, they're still going to pick up the phone and say the same thing they said yesterday. So there are those issues, but I think it's whoever we're talking to has to trust the four people that are sitting up here. So, I mean, we have to have a reputation that we mean what we say and say what we mean. And as I think Ruben and Chad said, talk to some of the people that we've acquired. Feel free to do that. As a matter of fact, in our second deal, they spent a day with the man on the first deal. And obviously it worked, so he must have said the right things. And that didn't cost anything. And I don't mean that in a funny way.
Sure.
The fact of the matter was, we took care of him and his employees, and he was more than willing to say, this is what happened, here's how it happened, here were some of the pitfalls, but here's how they overcame them.
Mm-hmm. Good.
I mean, I think you guys heard, agree with what you've heard, and I think there's a statement about or phrase about trust but verify. So as Dave said, you've got to be able to trust the person you're talking to, and what they say their vision is and what they say their culture is and all those things, but then you've got a chance to verify it. And, as Ruben said, I think he said 30 some acquisitions over the last several years. We've done 14. We've got 1,900 employees. I'm sure you've got a lot more, but those were all for both of us. I know those were all acquisitions. Those are a lot of ways to verify what that experience has been and verify that you should trust what you've heard.
First off, everybody we're talking to has some sort of interest in selling usually. And so they're kind of stepping in and we're stepping in. And I have the same conversation with every ex-owner. And I went to work for my father-in-law and he sold his business. And when he sold his business, it was more than his life. It was his life. And it killed him for a year. He hated me because I took it over. But I tell that story to every ex-owner because every ex-owner says, yeah, I'm ready. And they're not. Most of them are not. Some of them are, but most of them are not. And things do change. Chad said it. You can say things aren't going to, that's not the case. Things do change, even if you pay weekly and they pay biweekly or the opposite. That's a change for employees. There's certain things that do change. Might be small, computer system or whatever, but we also transparency and being honest and upfront. And that really helps. But I do have the same conversation with every owner.
I've had a request from the audience to deconstruct our inning metaphor and answer that question in terms of years. Since we all measure our businesses in years rather than innings, we'd like to know how do you see, how long can this continue? How much more growth, good times do we have ahead?
It wouldn't surprise me if we have another 4 years of just the steady growth that we've seen over the last few.
We look for 3 to 5.
In 2011, when we started Kodiak and started raising some capital, we told our very first investors that we thought they should plan on being invested for 10 years at least in Kodiak because we thought it was going to take that long for the industry to really recover fully. I think that's still our view.
I think that 18 and 19 are going to be quite good. I think, and this is just my view of what things I've seen, but I think 20 might be a little bit of some flattening out. I do.
So then, with 2 minutes left, if you could each, and this is maybe a stretch for the final question, if you could each just list what you see as the key challenges that the industry has to address in the next few years, or the key challenges that we're facing right now, in a more of a bullet point fashion, with maybe a half minute each left, realizing that's a short amount of time. Chad?
Labor's going to be tight. I think that will continue to be an issue. Obviously, today, lumber inflation, but not just inflation in lumber, inflation in all our expense categories. Payroll, fuel, costs are going up across the board, and it's going to be a challenge for us to be able to pass those on.
I agree. Labor will be important, especially in the truck driver arena. I think Ruben already mentioned that and Chad as well. That's a tough thing for us because the competition is everybody who drives trucks, not just other lumberyards. So, and there's a lot of, I think the not only inflation in the wood products industry, but also availability. So if we can get it, we can sell it.
I'd just add talent development to the list.
I would add there's a lot of change in whether it's manufacturing, distributing, even contracting. And I think that's going to continue to consolidate. We're seeing the roofing guys get into the drywall business. USLBM is going public here, and they have a bunch of different businesses and a different strategy about going things. I think we're going to continue to see change, and I think we all have to change with it. And obviously, labor is a big deal. Immigration is a big deal. And we had over 2 million housing starts in 2005, and we have about 1.2 something right now, maybe. So, and we can't get it done.